FMCG player Jyothy Laboratories notched a sales growth of over 6% for the quarter ended March, with huge contribution from the dishwashing segment. Overall operating margin was a disappointing 16.4%. Let's do a three-point analysis of the key highlights of Q4 earnings and the outlook on the company. 1. What does the Q4 results snapshot look like? Well, the dishwashing segment, which constitutes 32% of Q4 sales, continued its strong showing with over 21% growth aided by both EXO and Prill brands. New launches, particularly Prill Tamarind, have supported growth in a significant way. However, surprisingly, its market share has dipped on a sequential basis. Fabric care, which constitutes 37% of sales, saw subdued growth in Q4. But the company witnessed market share gains for its key brand Ujala fabric whitener. Having said that, weak margin in the category needs a close watch given the oil-related raw material headwinds. Personal care, which accounts for 9% of the sales, saw sluggish growth in line with the commentary from Godrej Consumer as well as HUL. Now, household insecticide segment was the worst impacted. The key brand in the category, Maxo franchise, saw its sales decline by over 4% in the seasonally better quarter. EBITDA margin dipped over 2 percentage points on account of higher cost of goods sold, advertising spends and employee cost. Except for personal care, operating margin declined for the other all segments. Personal care segment clocked in EBIT margin of over 33.7%, a significant jump from the past few quarters, aided by cheaper raw materials. 2. What are the other key observations? Well, in recent years, the household insecticide segment has been impacted by growth in the illegal incense sticks. Now, this is a category-wide challenge enumerated by market leader Godrej Consumer as well. Jyothy Laboratories has been able to counter this challenge through new product launches like natural incense sticks. However, intense competition has capped the growth and adversely impacted margin as well. 3. What's the outlook on the company? Well, Q4 was below expectations, particularly on the margin front. It also signals elevated competitive intensity in a few categories. While the management notes that there has been some moderation in the rural growth, it doesn't point towards a major stagnation. As far as the near-term outlook is concerned, the management has guided a 12 to 14% standalone sales growth in the current fiscal. Through advertising, spend is expected to grow by nearly 2 times. The company also expects to deliver a 15 to 16% EBITDA margin in FY20. The stock is currently trading at a 52-week low and trades at 27 times its FY20 estimated price to earnings, which is at about a 40% discount to average PE of other FMCG majors. Now, this valuation discount should shrink going forward as the earnings potential unfolds further. Now, investors can keep this stock on their investment radar.